Happy Friday, Brian Manning here with your weekly update. Let's get right to it. So Monday this week we were closed. Embarrassing though, last week in my video I said we are going to be closed for President's Day. It wasn't President's Day on Monday. It was in observance of Martin Luther King Day. But markets were closed on Monday. Tuesday this week, relatively quiet news day. Really, actually a relatively quiet news week. But Tuesday of this week, stocks are just roaring. Why? It's earnings season, and all the stocks are loving corporate earnings right now because they're coming back very positive. So we just continue to see this run up at the stock market. Wednesday this week, we really got some feedback on the sentiment of bulls and bears in the stock markets. And these are people that are either excited or not excited about the stock market. And right now, the bullish sentiment is the highest it's been since 1986. And what's amazing is that in 1986, when the bullish sentiment was the same as where it's at right now, it was also on the heels of a tax cut, which is what we're looking at right now, or tax reform, whatever you want to call it. But what's amazing as well, if we look at this, was that Black Monday happened in 1987. So I'm not saying the history will repeat itself, but it's interesting to see that we're kind of mirroring what happened in 1986, and we just have to watch the market to see what happens. Thursday, mortgage rates are moving. Why are mortgage rates moving? There's not a lot of changes in the marketplace. We're seeing similarities in our markets this year compared to last year. It really comes down to two factors right now. We've talked about this before, the Federal Reserve. The Federal Reserve, through their process of quantitative easing, created a balance sheet of about $4.5 trillion as a combination of mortgage-backed securities and U.S. Treasuries. Well, they're trying to unload or unwind this balance sheet right now. So in October of last year, up until then, they've been reinvesting $20 to $25 billion a month to buy mortgage-backed securities. So that's a lot of bonds being bought. And now they're trying to unwind this. So October of last year, they reduced their buying by $4 billion. They're going to do that for a quarter. January this year, they reduced it by another $4 billion. That's $8 billion less that they're buying in mortgage-backed securities. In April, they're going to reduce it again. So April of this year is going to be reduced by $12 billion. July is going to go to $16 billion. And October of this year is going to drop down to a reduction of $20 billion. So when you have $20 billion, or leading up to it, less bonds being bought on a monthly basis, when there's less bonds being acquired, mortgage rates are going to go up. So this is going to be a natural process. In addition to that, foreign investors are buying less bonds. Why? Because the dollar is weakening. Even though historically the U.S. has had higher yields in their bonds than other countries around the world, when the dollar starts to weaken, foreign investors lose their incentive of really buying the bonds here. So between a lack of appetite for foreign investors and the Federal Reserve buying less bonds, we're in a rising rate environment, and mortgage rates are slowly going to increase. Now, it's not going to be a straight line up. It's going to be a little bit of a seesaw, but we're definitely in a rising rate environment. I'm around all weekend. If you have any questions, let me know. Would love to help you. Would love to be part of your business. Happy Friday. Have a great day.